The CRA can legally charge you over $100,000 in HST on your own home renovation. Not a business, not a flip, your home. And they already published the rule that allows them to do it. Most Canadians still think this rule does not apply to them. Some think it does not exist at all. So today we are opening the CRA's own document line by line and showing you exactly what it says. By the end, the question will not be whether the rule is real. The question will be whether it is already too late for you to do anything about it. This is Canada Property Watch. In our last video, we showed how ordinary homeowners were being hit with six-figure HST assessments on renovations they believed were completely closed. Some viewers believed it, many did not. Today, we are not asking anyone to take our word for anything. We are reading the CRA's own documents. Every objection from the comment section gets answered with the specific statutory language that addresses it directly. That document is called RC4052, GST and HST information for the home construction industry, updated as recently as 2024. Sitting on Canada.ca right now, search RC4052 and you will find it in under 30 seconds. Everything we are about to walk through comes directly from that guide and from the Excise Tax Act provisions it references. But before we get into the law, I want you to keep one person in mind throughout this entire video. We will call her Sandra. Sandra bought her home in East Toronto for $700,000. Over 3 years, she renovated the kitchen, both bathrooms, the basement, and replaced flooring throughout the main and upper levels. For the total cost, $150,000. About $60,000 went to licensed contractors who issued proper invoices. The remaining $90,000 went to workers paid in cash. No invoices, no HST charged. When the renovation was done, the home was worth approximately $950,000. Sandra listed it professionally, sold it, and moved on. She made money on the sale, and still walked away owing the CRA close to $100,000. 14 months after closing, she received a letter. That letter is what this video is about. The first objection we received after our original video was the most common one. The rule only applies to professional developers and construction companies. Ordinary homeowners are not builders. Now, this makes complete sense if you are using the word builder the way most people use it. Someone with a hard hat, a general contracting license, a project timeline. That is not what the word means under the Excise Tax Act. The CRA's own RC4052 guide defines a builder for GST and HST purposes, and the definition's broader than almost anyone reading it for the first time expects. A builder includes a person who carries out or engages someone else to carry out a substantial renovation of a residential complex in the course of a business or an adventure or concern in the nature of trade. Here is the phrase that changes everything. Adventure or concern in the nature of trade. You don't need a business, you don't need a company, you don't even need to have done this before. One renovation, one sale. That can be enough. The phrase does not require a prior history. It does not require a business registration or a GST and HST number. It requires only that the renovation was carried out with a commercial purpose, which the CRA can infer from the sequence of events. You renovated substantially, you listed professionally, you sold at a significant gain. That sequence, reviewed in order, is the pattern an auditor is trained to recognize. If you hired a contractor to renovate your kitchen, your bathroom, your basement, you may already meet this definition. Not because of what you intended, because of what the totality of your actions looks like from the outside. And this is where most people get blindsided. The second objection raised in our comments was that the CRA cannot retroactively determine your intention. You renovated to live there. You sold later for personal reasons. A job offer, a family change, an offer you could not refuse. The agency cannot reach back in time and recharacterize your purpose. This is how most people think about intention, a fixed mental state at a specific moment. The Excise Tax Act does not work that way. The CRA's published guidance, confirmed by tax court jurisprudence, establishes that a person can have both a primary and a secondary intention at the time they undertake a renovation. Your primary intention may have been to occupy the property. Your secondary intention even if it was not the dominant one, may have been to sell if the right circumstances arose. If the CRA can establish that secondary intention existed, the builder characterization applies, and the evidence they use to establish it is not a confession, and when it is a pattern of behavior. Think about Sandra. She lived in the home for 3 years. She renovated progressively. The market moved. A good offer came in. She sold. To her, that was life. To the CRA, that is a pattern. Substantial renovation. Professional listing with staged photographs. Sale price significantly above purchase price plus market appreciation. She never thought of herself as a builder. The CRA did not need her to. Now, the CRA's own document appears to give ordinary homeowners protection here. It states that an individual is not a builder unless they renovate housing in the course of a business or an adventure or concern in the nature of trade. If you genuinely renovated for personal use and sold for personal reasons, this language seems to carve you out. But the adventure or concern concept, when as interpreted by the tax court across multiple decisions, is not limited to people with a pattern of flipping properties. A single transaction can constitute an adventure in the nature of trade if the totality of the circumstances points toward commercial motivation. And the circumstances the tax court has accepted include exactly the kind of renovation Sandra completed: comprehensive in scope, professionally listed, sold at a substantial gain. The protection the document appears to offer is narrower in practice than it reads on the page. This is the mistake almost everyone makes. They read the exemption language and believe they are protected. They are not asking whether the exemption applies to them. They are not asking whether anything they have already done has eliminated that protection. And by the time they find out, no, the assessment has already arrived. Now let us talk about the 90% threshold, because this was the third major objection, and it is a legitimate question. Is this threshold realistic for an average homeowner? The RC4052 guide defines a substantial renovation as one in which all or substantially all of the interior of a residential complex is removed or replaced. Substantially all generally means 90% or more, but not 90% of the cost. 90% of the interior rooms or spaces affected by the work. Sandra renovated her kitchen. Both bathrooms, the basement, flooring throughout the main and upper levels. The bedrooms were not touched structurally, but the kitchen, both bathrooms, the basement, and all major living areas represent the overwhelming majority of interior square footage. An auditor reviewing that scope against this definition does not need to verify every invoice. They look at the scope, they look at the listing photographs, they look at the permit records, and if your home looks fully renovated in listing photographs, that is often already enough for an auditor to flag the file. The fourth objection, the most substantive one, was that if the CRA treats this as a commercial transaction, the homeowner should be able to offset the assessed amount with renovation costs, legal fees, and other expenses. This is correct, and it matters. But the numbers you are about to see are where this becomes financially devastating. If the CRA determines you are a builder, you are entitled to claim input tax credits for the GST and HST you paid on renovation materials and certain services. Sandra paid HST on the kitchen cabinets, on the bathroom tile, on $60,000 of properly invoiced contractor work. At 13%, that is approximately $7,800 in creditable input tax credits. Her self-supply assessment, calculated on the $950,000 fair market value, approximately $120,000. Total input tax credits available, roughly $25,000 when all documented materials and invoiced labor are counted. Net liability after credits, close to $95,000 on a transaction she thought was fully closed. That is the trap, and here is where the math turns against you completely. Sandra's $90,000 in cash payments generated 0 creditable input tax credits, no valid invoice, no documented HST, nothing to offset. She saved a few $1,000s upfront by avoiding HST on that labor. She lost the ability to claim tens of thousands in credits she would have been entitled to with proper documentation. The homeowners most exposed to the self-supply assessment are precisely the homeowners who paid the most in cash. The offset mechanism that sounds like a protection has almost no practical effect for the people who need it most. Now, before we get to what you can actually do, there is one piece of this that almost no one in the comments addressed. And it is the reason we said at the start that the question is not whether the rule is real. The question is whether it is already too late. Here is how the CRA finds Sandra: your listing photographs, your permit records, your tax filings, different systems. Same database, and you already gave them everything they need. The CRA has invested in data infrastructure that cross-references MLS listing data, municipal permit records, and tax filing history at a scale that was not operationally possible 3 years ago. When Sandra uploaded professional real estate photographs to a listing platform, she provided the agency with a publicly accessible visual inventory of every renovation in her home. The permit records from her municipality showed what work was formally documented. The gap between what the photographs showed and what the permits recorded, that gap is the trigger. Not a tip from a neighbor, not a random audit, a systematic, data-driven selection process that identifies this specific pattern and generates referrals to audit teams at volume. If your home looks substantially renovated in listing photographs and your permit records tell a different story, that discrepancy is already visible to the system. It was visible the day your listing went live. Now let us talk about what you can actually do. If you completed a substantial renovation and have already sold, and the sale occurred within the past 4 years, your exposure window is still open. The CRA has up to 4 years from the date the self-supply liability arose to issue an assessment. You need to consult with a tax professional who has specific expertise in GST and HST matters related to residential real property. Not a general accountant, not your real estate lawyer from closing. A commodity tax specialist who understands the Excise Tax Act and the defenses available under it. The primary defense available to a homeowner who genuinely renovated and occupied their property as their primary residence is the personal use exception in subsection 191(5) of the Excise Tax Act. This exception provides that the self-supply rules do not apply to an individual builder who occupied the substantially renovated property as their primary place of residence, provided they did not claim any input tax credits on the acquisition of the property or on improvements made to it. This exception is real. It was designed specifically to protect ordinary homeowners who renovate and continue living in their homes. Sandra would be eligible, except for one thing she did not know about. 3 years before the renovation, Sandra registered for GST and HST because she operated a small home-based business. She claimed input tax credits on some home office expenses. She never received advice that those claims had any connection to her renovation. She did not know, and by claiming those credits, she forfeited her eligibility for the personal use exception without ever making a deliberate choice to do so. That is how the exception disappears. Not through fraud, not through deliberate tax avoidance, through a registration and a handful of input tax credit claims that seemed completely unrelated to the property at the time. If you are registered for GST and HST for any reason, a home office, a basement rental, any business activity touching your property, you need to understand what that registration means for your eligibility before you renovate and before you sell. If you have not yet sold, you have the most options available to you. The owner-built home HST rebate, documented in CRA Guide RC4028, provides a mechanism for recovering a portion of the HST paid on renovation materials for a property that remains your primary residence. The rebate can substantially reduce the self-supply liability where it applies, but it carries a strict deadline, 2 years from the date of substantial completion. If that window has passed, the entitlement is permanently forfeited. Most homeowners miss this deadline because they do not know it exists. One final question from the comments deserves a direct answer. A viewer asked whether homeowners would receive a refund if home values decline after the assessment. The answer is no. The HST liability under the self-supply rule is calculated on the fair market value of the property at the time the renovation was substantially complete, not at the time of the actual sale. If Sandra's home was worth $950,000 when the renovation finished and subsequently declined to $800,000, the assessment is still calculated on $950,000. The decline does not reduce the assessment already issued. No refund mechanism exists. But the number that should concern you most is not the assessment itself. It is the interest. Interest on any disputed amount compounds daily from the date the CRA determines the liability arose, not from the date the assessment is issued. Sandra received her assessment in 2026 for a renovation the CRA determined was substantially complete in 2022. She had already accrued 4 years of prescribed interest on the full principal before she had a single conversation with the agency about the merits of the case. The assessment arrives. The interest clock has already been running for years. For everyone who questioned whether this rule was real, the answer is in the CRA's own publications, Guide RC4052, Guide RC4028, subsection 191(1) of the Excise Tax Act, subsection 191(5) of the Excise Tax Act, info sheet GI-005, titled Sale of a Residence by a Builder Who is an Individual, all publicly available on Canada.ca, saying exactly what our first video described. The rule exists, it applies to individuals, it is being enforced with increasing frequency, and the homeowners who do not know about it remain the most exposed. The system does not need you to break any rules. It needs your listing photographs, your permit records, the gap between what the photographs show and what the permits document. That information is already in the system. It was already there when your listing went live. And by the time most homeowners learn this rule exists, they are already inside the audit. By the time you find out it applies to you, the clock has already been running for years. In our next investigation, we are going to expose what connects every trap we have documented in this series into a single coherent picture. The principal residence audit, the retroactive reassessment, the renovation receipt review, the TFSA trading assessment, the Airbnb reporting requirement, the HST self-supply rule. None of these is a standalone enforcement initiative. All of them draw on the same shared data infrastructure connecting the CRA, the major Canadian banks, FinTrack, and municipal governments. Understanding how that infrastructure operates and what it can already see about you is the most important financial knowledge any Canadian homeowner can have in 2026. Subscribe to Canada Property Watch right now and enable your notifications, because that investigation is the one that changes how you think about every financial decision you make.